Good afternoon, everyone. For those of you who are on early, you got to hear a little audio visual fun as we didn't realize that we were live. For those of you just joining us, this should hopefully seem totally normal. Happy Friday. I hope everyone is doing well. We've had a little bit of interesting times in the markets in the last week or so, so it should be fun to get into it a little bit today. And I'm looking forward to talking about couple things that I think will help people think about the times that we're in. We'll also have a little bit of housekeeping items and just catching up on things in general. So welcome, happy Friday. It's our first town hall of 2025. Cannot imagine that it's already March. Feels like we literally just turned the beginning of the year, but time flies when you're having fun. So I'm gonna go ahead and share my screen, jump into a presentation here, and hope you guys enjoy today. All right, we can't do any talking unless we have a little disclosure, so let's start there. And now we've done all the legal stuff that we're supposed to do, so now we can talk about whatever we want to. By the way, our good friends Cody Smith and Neil Hunter Smith say hello. Cody is on a ski trip to Alaska. Neil's headed to Alaska. Cody's headed to British Columbia. So they're both having fun, and you get the B team today. You get me talking about what's going on in the world. I first want to talk about our symposium that was just a couple weekends ago. Some of you on the call were actually there, so you know exactly what I'm talking about. But for those who weren't, it was a wonderful time. This is a picture of the event. We had 350 of our closest friends and some really entertaining speakers. Alex Smith and his story of his leg and just what he was willing to talk about and what he went through as a pro athlete was pretty insane. And people had a wonderful time on a beautiful day. So thank you to those that came. Hopefully this reminds you next year when we do it again that it's an event you don't want to miss. But I'm going to talk a little bit about the message that I gave from the stage at Symposium. So if you weren't there, this is new to you. We always pick a theme for our event, and this year we chose the theme of resilience. We've thrown it for a couple reasons. One, the speaker's story really lent itself well to that because Alex Smith almost lost his leg, then almost lost his life, and made it all the way back to the NFL. And is in changing people's lives now with sharing his story, which is very cool. He's a very resilient person. He also has a daughter going through cancer, and so his whole family is showing resilience now. And so we thought it made sense, but I also think it might be the superpower that we need for today's day and age. And we definitely need it as investors. And so I'm going to spend a little time on that, try to tie it to what happened to the markets last year and a little bit what's happening now as we talk about the world today. So the dictionary defines resilience as an ability to recover from or adjust easily to misfortune or change. And I think people focus on the misfortune part, but really it's just change, the ability to roll with the punches, to pick yourself up and do it again. And I think in today's world with so much coming at us, that's probably more important than ever. The Gallup company does a survey. I think they do it every year, but maybe every other year. And in the year 2000, they asked Americans what they thought the standard of living would be for their children compared to themselves. In 2000, 70% of Americans thought the standard of living for their kids would be better than it was for them. So pretty optimistic culture. Today, recently, as about a year ago, that number has fallen to barely over 40%. Statistically, that is a big change. That is a much more sinister outlook, as people definitely not thinking that the world is a great place if that many Americans suddenly feel like their kids are not going to be as well off as they were. And it's kind of curious to see that in light of what has happened in the world since then. We went and did a little research on just a couple of things, just picked a few things in the world since 2000 to today. Violent crime rate, almost 25% better. Cancer survival rate, which is almost hard to believe because I think we're also discovering all these new types of cancers. And it feels like it isn't a week that goes by without someone that you know being touched by that horrible disease. But believe it or not, we are surviving. Our survival rate is 20% better today than it was in 2000. Median household income adjusted for inflation. And so you hear all these numbers about, how it's not inflation adjusted or it's not fair. Almost 46% better since 2000. And household net worth, once again, on a median basis, is up 40% from the year 2000 to today on an inflation adjusted basis. Those are unalloyed goods. There is no way around those being wins. And yet, way more of us think that things are going to be worse in the future than they are today. What gives? Like, what's going on with us that makes us feel this way? And I'm sure we could find a whole bunch of reasons, but this is mine. I think this is one of them. The world is just super noisy. There is a 24/7 news cycle. Politics is anything but uniting people. Social media is feeding this. We have this sort of dichotomy that when you go down this road, and we're getting it today as Trump has started his agenda and people get upset about it. I mean, you are forced into a camp. And it is very interesting to see people just squawking about whatever it is. And therefore, if you're on one side, then you have to disagree with everything. And if you're on the other side, you have to agree with everything. And I think that's crazy and doesn't make any sense. And it doesn't help for any of our dialogue or solving real problems. But it is a very noisy world and it's all just piped right at you. Like the whole business model needs you to pay attention and it needs you to be worried about it. And I just feel like we're just amazing at creating anxiety today. And the whole AI phenomenon, which has this opportunity for incredible potential, also creates a whole bunch of anxiety around how many jobs will be lost and are the bots going to take over and what is this going to mean? And it is change for sure. And I think change generally and the speed with which it's happening, combined with all this noise, just really narrowed in on you, can really lead to a feeling of people being generally anxious, generally worried about the future, and not being particularly happy, despite pretty incredible benefits today versus, say, 25 years ago. And if you imagine 25 years forward, 25 years ago, we were just talking about the dot-com bubble. The internet was a baby. And when you think about how much that's changed our life, literally what we're interacting on right now is a Zoom session that was enabled by the internet that we wouldn't even have dreamed of when I started my professional career. I can't even imagine what is going to exist 25 years forward in our world. And I'm sure it won't all be wonderful, but I bet there will be some pretty amazing things too. So I just take that as a starting point to say, hey, you know what, to be a good investor, you have to get through the noise. You're going to have to look through that, see past it, and understand that it is a long-term game because we live in a very noisy society with more and more tools created to pipe that noise to you directly. AI is going to even find that hot button for you that you really get excited about and try to feed you nothing but that all the time because then they can sell more advertising and have more impact. So that's the world we're living in. There's a famous quote by Charles Swindoll. It says, life is 10% what happens to us and 90% how we react to it. I have a good friend named Dan O'Brien who runs a consulting company. He liked this so much that he actually named his company after it. It's called 1090 Consulting. He helps our leadership team a bit. And so he reminds us of this all the time. And it's hard not to make your reactions be a bit outsized. And sometimes as investors, we are really prone to react at the wrong moments. And so the input just is what it is, but our reaction could have far-reaching consequences. And we've seen a little bit more phone calls tick up in the last week or two as the markets have been choppy and the Trump administration has been putting out their rhetoric and people have been excited about it on one side or the other. And so we have to be careful about those reactions. They say the old fight or flight mechanism, if you're faced with a saber-toothed tiger and you need to decide to run, that's probably a good decision. When you're doing it as an investor, it's definitely not the best decision. And we can talk about that a little bit further. So we want to think about what our reactions are. And what we've noticed is that connection is the key to resilience. And I threw some pictures of here just of friends, right? Having that cup of coffee with your neighbor, going for a walk with a friend, that phone call to a loved one, to a trusted advisor, et cetera. We certainly feel like we are part of that connection for you. We're grateful when somebody is worried about something and they pick up the phone and call us and we're on the other end of the line. So we could say, tell me more. How are you feeling? What is this making you worry about? And hopefully we're able to dive into the financial plan that was built, into the buckets of money that we've created with layers of safety for moments that you can't control. And then that connection, that interaction, that moment to take a breath and let your heart beat slow to say, okay, what do I really need to do about this? Does lead to much better decisions, right? And I'm sure in every major decision in your life, when you've consulted loved ones or people you respected, you felt like you had some clarity and a better opportunity to make a decision. And certainly we hope to be that for you as it comes to the financial realm and making sense of things that seem scary or are moving fast, et cetera. So I encourage that. I encourage those phone calls to us. And I certainly encourage you to spend time with those you love. The other downside of our connected world is we can do stuff like this. And I love the fact that I can just jump on a Zoom and have you guys jump in and hear about it. But it's not the same as shaking your hand. And one of the favorite things we have about Symposium is we give everybody a big hug and get to press the flesh in person. And so I just encourage you to find those relationships where you can do that and spend quality time with people. Maybe turn off the internet feed for an hour or two, because who knows what's going to happen in there that will suddenly grab your attention and make you feel like you really got to worry about something. So let's take it to some numbers from last year, 2024 market recap. Because this is the first one of the year, I think it was appropriate to look back and we could talk about what has happened. And 2024 was really a pretty spectacular year. And what I'm showing you here on this chart are, I'll call them the four major asset classes. That's not exclusively true. There are others. But the purple line here is the S&P 500. Everybody's heard of that. 500 largest companies in the United States that had a whopper return year of 25% in 2024. We have the Russell 2000 that represents what we call small company stocks. You may not recognize all the names. They're much smaller than large companies, but they had a pretty good year, double-digit returns. The MSCI EFA is the international index, so they perform much poorer than the United States in 2024. In fact, that gap between the 25% for the S&P 500 and the 4% for the EFA was the largest gap going back something like 30 years in the difference between US and international markets. We'll come back to that a little bit later. And then bonds, as represented by the Bloomberg US Aggregate Index, were only up 1.25%. And that's because interest rates were a little bit sticky and everyone's hope that they would come down did not materialize. In fact, they even went up a little bit. So it really was kind of a lousy year for bonds. And so when you see this, I would say the news headlines or sort of perception was that everything was fantastic in 24, and it really was. Large cap United States technology pushed the S&P 500 really forward. However, most of our clients, and I'm supposing most people that you know, wouldn't have realized the 25% rate of return because you weren't putting all your money in the S&P 500. Maybe nor should you. We'll have some conversations about that in a moment. However, still a good year. Diversified portfolio up, depending on the level of risk, somewhere between 10 and 15%, maybe 12 and 17%, depending on risk. A good year by all accounts, especially coming after 2023, which was also a really good year. And that followed the 2022 bear market. And so that leaves us into 2025. And what do we do now? I apologize for all of the numbers on this, but when I hit the animation, hopefully it will help. We're going to highlight all the times that the S&P 500 has been up 20% or more back-to-back years. And so as you see these little yellow squares go on, these are the times in history where it was back to back. And there was time there in the 90s where we had 5 of them in a row. What is going to happen now? We just don't know. If you look back at some of those, you'll see, oh gosh, the next year was -7. The next year was -35, but that was 1937. My goodness, that was the Great Depression. Then obviously we had the tech crash of 2001 and 2002. That followed 5 years of great returns. It's really kind of random. And so one of the questions that is often asked to us is, hey, what should we do? The markets have just been really good. Does that mean it's going to be really bad the next year? Nope, it doesn't mean that. I will say it's hard to imagine it being as good as it was the last two as it relates to large cap US stocks. But when we dig deeper into some of the other indices, they didn't have quite the same year. They're not at quite the same valuations. And we've seen some of that play out in the very early days of 2025. So it is relatively rare that we get back-to-back years over 20% in the S&P 500. Not really able to draw any conclusions about what happens next, even though I know everyone wishes we could. All right, what's happened 2025 year to date? I grabbed this chart an hour ago, so it's as close as I could get to accurate. I don't think the market moved too much between noon and 1 p.m. unless I missed something that there was a news story that wasn't there. But this is a little bit more interesting. So if you track the same, the S&P 500 year to date is actually negative now. That has happened in the last week or so. You can sort of see that on the right-hand side of the chart here where the purple line jumps down a bit. The tan line is the Russell 2000. That's small cap stocks. They tend to be more volatile. When the stock market is rising, they've historically done better. When it's falling, they fall worse. That has not been the case recently, as large caps have been the only good performer and the small caps have really been left behind. But as you can see, they are struggling the most out of the gate here in 2025. But while no one was talking about it, and I still haven't heard a word about it in the financial media or when I turn on a general market update thing on the radio, the EFA, the international markets are up double digits year to date. And so the diversification of having that in your portfolio is certainly paying off right now. As are bonds. Bonds are doing their job as a buffer to downside risk. They are a good positive 2% already, and we're only a couple months into the year. And as we know, this doesn't mean anything for how it's going to turn out this year. But I do find it helpful to illustrate that not everything goes down at the same rate. And some of the stuff that's going on in our world is impacting the US market, but maybe not the international market as much. Now, all of that could change when we talk about the tariffs and what's being put on there. That certainly stands to hurt some of our international trading partners more than us, but it definitely hurts our multinational corporations as well. I've been trying to do as much reading on tariffs as possible. I can't find an economist who thinks it's a great idea, but there is a grand experiment happening with the current administration, and it hasn't been tried before, where they're going to increase tariffs at the same time cutting taxes. So trying to spur the economy on one side while gathering revenue from outside our country on another. And I think the general consensus from economists is that they don't like it. But if they're being honest, it hasn't been tried before, and we'll see how it plays out. I also think that we're in a super reactionary moment. And so in maybe the last 2 weeks, you've seen much more volatility on the market than you've seen in quite some time. It is a little bit closer to normal, to be fair. We went 2 years there with very little actual volatility, lots of good growth, but not very many days where markets were down 3% or so. And we've had some more of those recently. I think we'll probably have more of those going forward. But you see the reactions being pretty swift. So you have a bad day, Trump's going to put on the tariffs, the market freaks out. Trump eases the tariffs or says he might reconsider them 6 hours later, and the market goes the other way really quickly. That's the sign of an unsettled market, a market that doesn't know what it's going to get. And that's usually a nervous market. That's just the participants that are in that marketplace reacting very quickly to information. If you're a long-term investor, and if you're certainly paying us to be your advisors, you are a long-term investor, and that's the only way we think about it. I'm not worried about that short-term stuff, except for how it hits your psyche. So I care about how you feel about it. I care about what it's making you want to do as far as decisions, but I'm not very worried at all about the long run of any great company that we happen to own just because of the tariff policy, et cetera. So we will see through that. We will get to the other side. That's the resilience we're talking about. And if you have buckets of money, those of you who are taking income, and we've got money set aside for the next couple of years worth of spending, all this tariff talk will be in the rearview mirror by then. It'll be something else that we're concerned about. And if you have diversification and you're not all in one asset, and we did take over a client a couple of weeks ago that literally had 95% of their investments in one company, and we've made short work of changing that because that was a level of risk that just doesn't make sense. But if you are diversified and you have those layers of risk in your portfolio, even though it's impossible to ignore the noise, I do truly think that you don't need to worry about that noise for how it's going to impact your long-term returns. And I know that that's probably what you expect us to say. I could probably go on Bloomberg or CNBC and make a much bigger splash if I made a call and said, this is going to happen for sure in the next 6 weeks. It just wouldn't be right, and it wouldn't be the right thing to do for you guys. So I feel like as we look at this chart of what's gone on year to date, it's probably a good time to talk about those fundamentals and what really matters to your plan. And I am grateful to see that diversification is working and that the international and the fixed income markets have held up better even through this recent US volatility. As we talk about our US market and what might be happening in the future, I want to draw your attention to the past. This is a slide from JP Morgan. It's actually kind of cool. It might be hard to read on your screen, but it lists the top companies in the world by market cap by decade. So 1980, 1990, 2000, you see the red box around the year 2000, kind of using that as my touch point 25 years ago. Typical person entering retirement the next 25 years is an important component of their life. If you look at those companies from the year 2000, there's only one of them that remains today in the top 10, and that is Microsoft. All of the other ones have fallen out of the top 10. Even the 2010 data, there's only 3 of them that still exist in 2020, and it's hard to say which of those might be around in 2030. Stuff changes. It is hard to imagine one thing staying the same forever, and so we try to remind clients of that when any particular thing does very well. You've heard us on these calls over the last maybe year or two, really talking about concentration in the market and the Mag 7 or the top 10 companies now making up almost a third of the S&P 500, and really worrying about diversification from that standpoint. This is a reminder that just because they were great once doesn't mean they will be great forever, and it's impossible to know which one of those will be the ones. I found this to be an interesting slide because if you took NVIDIA out of the US market, and this is a stat that went from October of 22 through the end of 24, obviously that has come back dramatically here in the last couple of weeks. The US market performed just about the same as the Euro markets overseas, and Europe didn't do particularly well. And so we've had this great run in 23 and 24, much of it driven by United States technology, more of it than we want to admit, being driven by one company. We have seen NVIDIA give about 30% of that back top to bottom here in the last couple of weeks. They're still way, way up from where they were. But it looks like some of that readjustment is underway. It doesn't have any judgment about NVIDIA at all, but more to say those sort of outliers in the market don't last forever. And I did find it interesting that one company had such a large bearing on the US rate of return. We're kind of grateful at this point that we didn't go chase that. We didn't go all in on technology. We didn't try to double down on those things that we're doing the best, given what we've seen in the last 2 weeks. And I'll wrap up my time talking about NVIDIA here with sort of a link to the past. When I started my career, it was late 2000, early 2001. And right before that, Cisco Systems. I still have clients who used to work at Cisco Systems and have retired from there, most of which are quite glad that we diversified them out of their stock at this point. Hit an all-time high in 1999, right before the dot-com crash started in 2000. And what this chart represents is something called the PE ratio. It's the price earnings ratio, which is often used to determine the relative value of stocks. All things being equal, a lower price earnings ratio indicates a cheaper stock, and a higher PE ratio means a more expensive stock. And faster growing companies typically carry higher PE ratios than old, stodgy, boring ones. But nevertheless, sometimes they can just get completely out of control, like what happened in 1999 with Cisco. As you can see on that chart, the peak was 125 times, which is just bananas bonkers. And we were all talking about NVIDIA and about how crazy it had gone, but it was really only trading about 40 times, even recently. And I looked at it yesterday. I did not look at it today, but yesterday it was trading at 24 times. So while we talk about this, it's kind of helpful to have this discussion. If you're looking at the screen before where we're saying one company was incredibly important to the success of the US market, and then we want to look at it and see, well, is that company doomed? I would say no compared to Cisco back in the day, but I wouldn't try to make a call on NVIDIA either way. One interesting fact about Cisco stock is that to this day, it has never reached its stock peak again. So that peak in 1999 has not been met again, and we're 25 years later. So even though it's a great company, even though it's held thousands of people in employment and done well for many, many years, stock prices can get totally dislocated. We don't have to talk too much about NVIDIA. It's corrected pretty handsomely here in the last couple of weeks, but I think it's helpful to sort of hold those two things in your mind. A, it doesn't seem to have gotten near as crazy overvalued as the tech bubble in 1999. B, it's probably going to have some volatility when it gets out of control, and we've seen that kind of recently. So when we take this and we look at it from the standpoint of what's next, I think many of you are asking us for the green light or the danger sign. You know, is this going to be green light? Let's go. Let's continue making double-digit rates of return, or are we in trouble? And do we need to do something that is drastic because bad times are ahead? And I think, as we talk about with clients on a pretty consistent basis, you can't know that. So let's just take the green light off the table. But at the moment, I think there's more emotion around the danger, right? Is there something coming? Are there falling rocks ahead? What do I need to do? The common refrain from clients to us would be, what do I need to be doing to protect myself? With the assumption being that there's danger ahead and there's something bad that we have to watch out for. And I'd say, well, we can't do that either, because it was almost universal at the end of 2023 that we were going to have a recession in 2024, and it did not come. Just didn't happen. Every economist out there thought it was coming, and it didn't happen. So same way I wouldn't predict danger here and be sure that it was coming only to see markets power forward and everyone miss out on that. Because if you miss the best days of the market, your total return is completely messed up for a decade. What I would say is probably more realistic. We're probably at a yield sign. We've had 2 really good years in the marketplace. Those of you that have had their meetings with us in the last few months, we've been filling up short-term buckets. We've been taking those profits. We've been rebalancing. We've even been gritting our teeth a little bit and paying some taxes on those capital gains from years gone by to get the portfolios allocated in a way where we said, hey, if the spaghetti does hit the fan for a minute or two, we're going to be fine and we're going to be able to live through it. If it doesn't, we're still allocated for the long run, still believe in equities for the long run. American economy is incredibly resilient. There's that word again. And those companies aren't sitting back and just waiting for bad things to happen to them. They're looking at what's out there in the world and figuring out how to be profitable on a regular basis. And I'm very confident in their ability. Governments can be terribly ineffectual. You can have huge disagreements politically with the people leading the businesses or leading the country. But the businesses themselves tend to focus on what matters most, and they'll figure out how to add value. And when they do, those profits come back to those companies and those stock prices rise. Temporarily, people get pretty worried and those stock prices can fall dramatically. And that's why you got to have diversification, why you have to have those different layers of risk in the portfolio. But if you do, you should feel very comfortable that this too shall pass. So there's my big prediction. I know you'll all be disappointed with my big yield sign, but hopefully that helps you with a little bit of perspective with what's going on here in the last couple of weeks. I got a couple housekeeping items that I want to do before we bail out of here today. It is tax season, and I'm sure everyone is very excited about that. But if you haven't already done so, this is a screenshot of your online access to your Raymond James accounts. If you wanted to know where to get them, if you have trouble, reach out to us. We will send them directly to your accountant on request. What we have found, and this is a big thing in our office as we try to support you better, we're like, gosh, we'd love it if we just made this easy for clients. What we found is that it's actually harder for the CPAs when we send them from a different source versus it coming from you in one package, especially if they have one of those online tools that they want you to upload everything in. So we're putting this here for you so that if you want to do it easily, you can grab this yourself, stick it with your tax organizer and load it up to your CPA. But if you're having trouble or you want us to send it directly to them, just confirm with us who they are and we will do it for you. But you go into your vault or your online access, grab my accounts, grab documents, click on tax reporting, and then you'll click down here to whatever is most recent. Please note, when you look at this, you want the one that is reportable. Some of them will say draft, some will say preliminary. Grab the most recent ones that say reportable that are good to go. So good fun as you're getting all that into your accountants and getting your taxes squared away. Let us know if you need assistance on that. And I wanted to hit on one other thing, totally unrelated to markets, but we all watched the fires in horror in Southern California. And then you heard some stories that frankly freaked everybody out, said, oh my gosh, these people were fighting with their insurance companies to try to get claims paid because their home was held in a trust because their financial advisor said in California, you really should have a trust to avoid probate. And the insurance policy wasn't in the trust, and now they were having trouble collecting. So if this is the case, now I'm quite confident the lawyers will get involved and those companies won't be able to get out of their obligation because of this technicality. But I would recommend that you go see your property and casualty agent and make sure your homeowner's policy allows for your trust to be listed as an additional insured on your homeowner's policy, because the last thing you need to be fighting about if you ever had a claim was that your policy was only for you and not for your trust, which owned the house. So kind of a small thing, but it would sure be a big deal if it happened to you. So I wanted to put it out here publicly as a reminder that I think it would be helpful. I appreciate catching up with you guys today. If you have questions, we sure would love to hear them. Obviously, there's the Q&A here, but most people aren't comfortable doing that publicly. Reach out to us, send us an email, make a phone call. We'd love to hear from you. We have seen some volatility for the first time in a while. I think we're probably due to see some more. The current administration likes to make a lot of noise. They often back away from their policies after doing it initially. The market kind of hates that because it doesn't know what to think. But remember, the market is just a bunch of participants, and what they're really trading are these great publicly traded companies that probably are interested in much longer time horizon than next week's tariffs. So when we think about that from a long-term perspective and build those portfolios with some resiliency, I'll encourage you to have some resiliency of your own and reach out to us, because we'll be the connection if there is a need to kind of walk you through life's be a little scary out there. Appreciate your time today. I hope everyone has an awesome weekend, and we'll catch up with you soon. You guys take care.